So, as promised, we're now about to bring in ChartTrader Brett Manning, and wow.
How you doing, Jim?
I'm doing all right. Pretty busy day for a Friday. Option X. I know you highlighted in your note. 90% of the time, it's goes off like a wet firecracker, but in this case, not so much, huh?
Yeah, it's a very binary kind of situation, and so you don't know whether this is a true signifying event for the market in terms of the technicals, really, because it's coming on expirations. The type of action can be exacerbated by the sort of games that get put in place by options players into expirations and during an expirations day when everything is finally getting reconciled. They pin things down, and then when the pins break, you can have perhaps an exaggerated reaction in the market that can be interpreted as, you know, this is how bad it is to see what's going on with Taiwan Semiconductor, or what's going on when you get a dollar breaking higher, or 10-year Treasury futures breaking down. But you don't know whether or not it's a true attribution because it may have to do with things going on in the options market. But you can't discount it either. So it's going to be really interesting to see how this market handles things next week. This is certainly not a tremendous signal for bulls.
Yeah, I would agree. Do you put any weight into the closing? Is it more or less significant on Friday on expiration?
Well, lately, there's some research I've read that suggests that we've had outflows from the market at a very significant level during the final 30 minutes, and that in the past that has been connected to early stage bear markets at times, so that's not necessarily a good thing. It's considered to be like a smart money indicator, the final half hour. You know, I don't know whether or not that can be applied, or whether that could even be a self-reinforcing feedback loop as people start to, you know, become more and more aware of this dynamic and traders start to play it. So it's tough when you use research that's really got most of its data points of significance, you know, years or decades ago. But it's definitely another, very similar to the situation where you're watching the action on OpX and thinking about whether or not this signifies that something where you can't discount it. It's certainly been the case that the final half hour has been quite weak, pretty much day after day for the last few weeks. So something to watch out for today.
Yeah, well, you know, it's interesting because the last few Fridays we've seen accelerated downside movement, and come Monday, we gap open 20 points higher. So
yeah, but in a lot of those cases, you're talking about a particular headline issue heading into the weekend. I mean, trade war with China, we're going to bomb Syria, whatever it is. And today, that's not really the story, right? This is not, I mean, we could say this time around, this is not because of a Trump tweet.
Yeah, that's true. Excuse me. Any ideas as to what you're going to be looking for next week? Trade setups. That's been kind of the theme of the day. You know, thinking ahead of time. So what?
Right.
You know,
so
what are you looking at?
Thinking ahead of time. Yeah. No, I gotcha. So I'm thinking that the most interesting thing that's happening so far today isn't the downside move in stocks. It's the downside move in the euro. And I caught a little bit of you talking to Gavin and talking about the ECB next week, and the fact that you know there's sort of a sense that, you know, they're kind of maybe dialing back a little on the time frame as far as being aggressive about normalizing policy, and that's certainly playing into it. But you can also check out the Euro futures commitment of traders data and see that, as we've talked about for the last month and a half, whenever we talk about this market, you could be bearish on the dollar and bullish on the euro, but you have to kind of contend with the fact that the euro is already sitting just completely crowded full of speculative long positions. And that makes it really tough. Even if you think there's a lot of reasons to think the euro may go higher, you got to deal with that. And then when you start to get some kind of flow in the opposite direction, saying, hey, maybe all this enthusiasm about the euro is misplaced right now, maybe things aren't going as well. I know they had a zoo survey that was negative, so you're seeing some of the soft data there turn and start to say, you know, maybe the enthusiasm level about the Euro area economy is a little bit exaggerated, and at the same time, the central bank kind of gives a little hint and a nudge in the direction of maybe not being so quick to normalize policy. You've got that market sitting full of speculative long interest right now. So that can lead to a fallout in the euro. If it does, even though if you look at data just on the dollar specifically, the dollar does not look like a crowded short. If you take it as, hey, the dollar index is 60% euro, and the euro is a crowded long, then it's kind of, you can look at that being kind of a sign of an unwinding that could lead to a dollar rip. So I think that the most significant thing that could happen right now to reshape the environment, even intruding into earnings season, as inserting a macro factor that's not just a headline issue, would be momentum in the dollar to the upside. I don't know that it's going to happen, but it's one of those if-then scenarios. If you get that dollar breakout, I'm clear of gold. And we talked a few weeks ago about the possibility of a big shakeout to the downside in gold. This could be something that could spark that. I could see, like a check all the way down to 1250, and then following that, a breakout to 1450 or 1500. That would really clean out gold and really remove the problem with that in the first place, which was the speculative interest, much like the euro. So there's a lot of things that can happen around that, especially crude oil and this recent momentum and sentiment around the energy stocks. Dollar breakout would not really help that situation very much. Energies have been kind of bracing the market a little bit as we've seen some selling in things like financials and tech. And then the other, so there's this whole narrative around the dollar and how it can play into a lot of different markets. And then there is rates. So we're seeing a new low in the 10-year Treasury futures today. We haven't seen the new high in rates, but it feels like it's coming. And that's a huge kind of thematic line right now for the market. When the market sees rates start to accelerate on the upside at the long end of the curve, gets a lot of people nervous. There's a little PTSD going back to early February, and the ability of the risk parity funds to be able to handle a situation like that, because if they've stormed back in, as we see unequivocally what is looking like one of the really, historically special earnings seasons, we're, a week into it and the market is basically flat. And we've seen a lot of good earnings reports. And if you've got risk parity guys who pop back in and they're doing their traditional model in terms of bonds as the other side of that coin, this is what happened. This is one of the themes that happened in early February to really dislocate things. I don't think it was the principal cause, but if you get bonds breaking down as stocks break lower on good earnings, in theory, you've got $500 billion or something in the risk parity model. That's a problem for them. So there's a lot of different factors that could be an issue. Maybe none of them will, but it's in my if-then contingency scenario, these are the things that I'm looking at as we head into next week. And I know that a lot of people are going to be looking at earnings, but it's important to understand there's still a lot of macro under the surface here.
Yeah, for sure. And we had highlighted that, so I'm glad that we did, so that people at least get a sense of how busy it's going to be. And next week, would you agree with Gavin's sentiment that next week might be the most important that we've seen, at least for this earning? Well, I guess I phrased that incorrectly, but will be the most important one that we will see for this.
I think there's a lot of things that are intersecting here that suggest decision points for the market. If let's paint a couple scenarios. Let's say, all right, it's one of the biggest weeks for earnings, right? Let's say earnings are great, and the market is right here at the end of the week. That would be, I can promise you I'd come in a week from Monday, short the market.
Yeah,
right?
Sure.
That's a gimme trade, and gimme trades are the best thing. So we still got that open space underneath this market right now with 2,500 below. That just kind of felt to me a couple weeks ago like it needed to be tested, and then we got kind of a really conciliatory speech by Xi Jinping. One of the big trades that I've missed over the last 12 days, we talked about the possibility of shorting UVXY when it was at 2150, and we got a tweet about, the missiles are headed to Syria, and I just abandoned that idea. And that was right at the point where if I had just taken that short, I would have made 35 or 40% in just a few days. That kind of relief from backwardation in the VIX forward curve, a VIX up, political headline risk, trade wars, all those themes we were sitting in 2 weeks ago had turned to conciliatory China, earnings are great, VIX down. That whole shift in mentality back on the other side of that coin, but we just made it to 50% to the trading range. I mean, if you look at the S&P chart, that's where we got to. Mm-hmm. We played the long on the breakout and squeeze of that wedge pattern we talked about a couple days ago. I pulled out of it at apparently the perfect time at 27.15. And that was right about the midpoint of the whole trading range we've seen since the top. And that's all we got to in that whole kind of relief scenario. Now we're into the thick of earnings season. And, you know, I got to say, my take on that narrative is we stormed higher from September to the end of the year and into January. And that was a discounting rally. You know, that was a big move based on essentially because of political catalysts as well as a strengthening economy. We are moving out of QE. We're starting to reduce the balance sheet. Remember that whole narrative in September and October of last year. There was a tailwind, an organic and sustainable tailwind that was kicking up in the economy, and it was around the world, and at the same time we were getting this huge tax relief that was going to go right to the bottom line for a lot of companies. And so it was a guarantee of big earnings growth in 2018. And what the market does with that when you have a guarantee of anything is it prices it in, right? And so the fact that we are seeing that type of earnings situation play out right now, we're seeing the market act probably as it should because it's not a surprise. This is not the new fuel. These earnings are not showing us something that's totally new for the market. These are the types of numbers that the market was anticipating and is the reason why we stormed higher from September to the end of January. And I don't know if earnings themselves are going to be able to take us on that next leg unless there's some new catalyst that's able to say that, you know, it's going to be even way better than we thought. And I don't see it right now. So I'm feeling a little more like we're giving up the squeeze out of the wedge and we've got some issues to deal with. I think that what we're seeing right now by stopping at the midpoint in this range is possibly turning this into a more protracted lateral kind of corrective wave that may take maybe the rest of the year. You know, we may be in this type of situation for longer than most people may be acclimated to in their minds right now. And then the question is, what's around the next corner after that? And we're going to get a lot of signals on that. And it's obvious that we could see a next leg in the cycle. We could see the type of sentiment we saw in equities in January hit the real economy, animal spirits in terms of how people are behaving, but we've seen some of that. So that's the sort of step that would need to happen as the next leg in this process. But I think right now we're seeing a little bit of a sense of we baked in these types of, you know, big earnings growth numbers and guidance, apparently, at this point. And if we start to see more issues on the macro front that kind of stand in the way as a bit of an obstacle, then it could just end up making this a little bit more of a protracted process, and we need to be playing both sides of things. So that's my whole big long term. You got the short term and the long term right there, back together.
Well, let's get even shorter term. You doing anything today? What are the odds?
The odds are tough to state. It depends on exactly the pattern because it would be, I'm not entering a larger time frame position right now today. There's zero chance of that. I may see a pattern develop on a short-term chart. In fact, it kind of feels a little bit likely that I could have a late day, let's kick some of the short interest out here and then maybe break support again into the close, kind of scalp short trade in an index futures contract. That would be probably what I'm focusing on most right now.
Okay, well, there you have it. So I guess you got to stay tuned and wait for ChartTrader to see if he's going to do anything more towards the close. Nothing right now, but man, we got a lot to look forward to next week.
Yeah, we got a lot to look forward to. And And again, as far as this afternoon, it is Friday, it is options expiration, and the signal-to-noise ratio starts to work against you in that type of situation. No matter how tasty looking the setup is, it's going to have to be probably perfect for me to feel like I'm going to put capital at risk. I generally move with largish size, and if I'm going to be doing that, I'm going to trade or I'm not going to trade, rather than I'm going to kind of half play ball. Like either it's something that I feel a tremendous amount of conviction in or not, and so the threshold is probably very high for it to get to as far as the pattern construction and the feel of the tape for me to put that trade on.
Well, when you have that conviction level, or anybody who, anybody who listens trusts with that type of conviction, I mean, then. Hey, you know what? If you're like, nah, I just might mess around, it's worth turning off the computer.
I do not, exactly right. See, one thing you can guarantee with me is I do not do that. I've been doing this long enough to know that whenever you feel that feeling, even just a little bit, it's better to not trade. Find your setups, know it's going to happen, put it on, and then immediately assume it's not going to happen, and gauge your mindset around size and risk. In other words, structure the idea of entering only when you know it's going to happen, and then the second you get there, then start to structure where your stop is and what your size is based on an assumption that it's not going to work. And if you do that every time, you're going to be right easily enough to make money over time. And that first part, getting that conviction level, having that type of faith, having the experience to say, this is something I've seen a bunch of times, I understand what's happening here, I know I have a special edge on this situation in this market right now, it's worth doing the trade. Get to that level, and then structure the trade as if you're somebody else who is your own risk manager, who's saying, we've got to assume that there's a good chance this isn't going to work. And that's where you deal with your sizing and your stops. But if I'm going to get to that threshold on a Friday afternoon on options expiration, it's going to have to be something that, that really looks very, very, very convincing.
You know what? I got a good idea for you. If you want that personal risk manager, and just have your wife take a picture with that, you know what, you've done something wrong face. Take that picture, put it right up on your desk, and put it up anytime you want to think about making one of those iffy trades.
And
right?
holding the triplets.
Yeah. You know what face I'm talking about. Everybody out there knows that face the significant other makes when you.
I know you do. Wrong. I can hear it in your voice.
Oh man, I got lots of.
Yeah, no, you're good. There you go. Exactly. There you go.
I can.
We'll write a whole trading book on it.
I can look at Scott across the way. He's giving me that look right now. So. So anyway, so there's your advice. If you take nothing away, there's your risk management pro tip. So
that's perfect.
All right, Chart. Well, you've given us fair warning to be on the lookout for a potential trade idea, perhaps later on today. So that's enough to stay tuned. Thanks a lot, Brett.
You got it. Thanks, Jim.
All right.